Hello everyone, this is Abhijit Chatterjee recording our weekly session for Chartsarefun for the week of April 21st, recording this on Sunday, April 27th. Another news-driven market. This week in particular, President Trump talked about Powell. He was extremely harsh about Powell on Monday. Market didn't like it. Treasury yield shot up, in particular 10-year yield shot up towards 4.4%. And then he retracted. He went back on Tuesday in a press conference, end of the day Tuesday, and he said that he had no plans to fire Powell, and also gave a huge leg up to the market, talking about de-escalation with China. He said that the eventual rates, the tariff rates with China would be much lower than the current rate in place at 145%, giving the market the de-escalation message that perhaps there is some form of negotiation, some form of a deal making that will happen with China. So market took off. In particular, this was a very strong week for the technology stocks across the industry sector spiders. These are the S&P sector spiders. Pretty much every sector spider went up except the staples, which we know is a defensive sector. That was the only sector that was down for the week, but pretty much across the board, all other sectors, the 10 of those 11 sectors were up. In particular, technology had an amazing week. XLK, which is the technology select sector spider, was up 8%. Nasdaq, as a result, as a key index, was up 6.5%. S&P was about 4.5, and Dow Industrials didn't do as well, was only up 2.5%. Part of it was IBM, taking a hit after earnings. And we also know that the week before United Health helped dampen Dow's rise. So the core message this week was technology-driven rally. The help that President Trump provided on China gave semiconductors a massive move of 10%, and the software sector was also almost about 10%. So those two drove technology stocks higher. QQQ had a solid move. And today we will look at what Tom Lee, the CIO of Fundstrat, the chief investment officer there. He often is on CNBC. He does his weekly recordings because they now have an ETF called the Granny Shots, GRNY. He does weekly market reviews about how the ETF is performing and also our macro conditions of the market and market internals and so on. So we'll share what Tom Lee talked about. He feels the bottom is in. We'll share his thinking why he thinks the bottom is in. From there, we're going to talk about gold. We've been cautioning gold bugs, the bulls on gold, to be very careful. And what we got this weekend was Barron's covered gold in their, the main homepage. That, being bullish on gold. That to me is in many ways a contrarian sign. Be extremely cautious when gold gets an attention in Barron's main page. So be cautious. I'm going to talk about the technicals on the gold chart, not just the near-term technicals, but a longer-term, looking at a yearly chart of gold going back all the way to 1970, why we think a major top is forming in gold. So we'd be very cautious about holding gold moving forward. We're going to touch on that. We've been cautioning about it for the last few weeks, but today we'll just talk about it again. We can talk about treasury yields. As we know, treasury yields have a big impact to small caps, have a big impact to the market overall. So we'll be looking at 10-year and 2-year treasury yields. And then from there, we will start looking at market breadth. This week, there was a big news about the Zwig thrust. This is the Zwig breadth thrust indicator, which is effectively a measurement of the advancers over the total number of stocks in the New York Stock Exchange. It had gone from 0.4 to 0.6 in a period of 10 days. He uses a 10-day moving average on the market advancers in the New York Stock Exchange. And there was a lot of chatter about the Zwig internal thrust indicating market strength and a lot of bullishness moving forward. We talk about market internals. We look at the summation index. We look at the McClellan oscillator. From there, look at S&P 500 chart, of course. And then start looking at the Nasdaq's internals, Nasdaq's market breadth, Nasdaq's oscillator, and then the Nasdaq ETF, the Nasdaq 100 ETF QQQ, because the Max 7 earnings are in focus. This week we had Tesla on Tuesday, and then we had Google or Alphabet on Thursday. Next week we got 4 of the Max 7 announcing earnings. The M's, as in Microsoft and Meta, announce on Wednesday. That's on April 30th. And then the day after, on May 1st, we have Apple, the A's, the Apple and Amazon. So two of the Max 7 earnings happen this week, and then four next week. So we can look at QQQ. We're going to look at, as I said, two strong sectors or industries that did well this week was software and semiconductors. We'll look at them, see where we think that could be headed, and then end with small caps. We are following small caps. They have been outperforming recently. We'll show you how accumulation of small caps have been extremely strong, indicating smart money is betting on lower yields. Small caps are extremely sensitive to yields. So smart money betting on lower yields down the line, that could help small caps, and small caps could have a strong recovery. And if you talk about market breadth is hugely powered by small caps. They are the biggest number of stocks in the exchange. So if the small caps start doing well, you can expect market breadth to improve, and that indicates more upside for small caps. We'll end with IWM, the small cap ETF. So straight into our blog site, chartsarefun.substack.com. We publish daily blogs. Appreciate you sharing your email, and you'll get the blog as soon as they get posted at 7 a.m., usually every day. Then our YouTube site is called Charts Are Fun as well. YouTube.com at Charts Are Fun is the channel. Appreciate you, if you watch the videos and you like it, appreciate you liking, hitting the like button. And also if you could subscribe to the channel, we get to share with you as these weekly videos come out. So as I said, I'm going to jump right into Tom Lee. He's the Chief Market Strategist and Chief Investment Officer of Fundstrat Capital. Here he does his weekly, and I'll share the link to the YouTube video, his weekly market recap. And what he's talking about, he's watching signals of where, with a high probability that he thinks the bottom is in, which if you think about where S&P touched the bottom, which is at 4,835, that happened on April 7th. But from a closing basis, the bottom was on the day after on April 8th. Here on the chart that you're seeing, we can see two columns, the macro sector, macro thought process, and the equity perspective. Macro thought process, extreme bearishness everywhere. We know that many of the pundits in Wall Street have been like Ray Dalio and others, extremely bearish, talking about economic Armageddon, end of the American exceptionalism. We know that Ruchi Sharma started off in December, made a strong prediction at that time. He had talked about US market taking a hit relative to the foreign markets, and there was a very prescient call in December. And but then others chimed in, and everyone is looking for the end of the American exceptionalism, not from a near term, but a longer term perspective. Many believe that a major top in the US stock market is in, and as a result, we can probably get into the 1929 to the 1930 kind of depressionary sell-off. And many are pointing to gold and munis. They are outperforming, indicating this is our safe haven time to be holding those and buying more of gold and munis. And we disagree that the gold has got much more upside. We believe that it has become too much of a crowded trade. Everyone's on gold. Yes, they're talking about central banks across the world diversifying out of the dollar because many of them hold treasuries, but they are selling off their treasuries and they're all diversifying into the dollar. As a result, no, not diversifying into the dollar, diversifying out of the dollar into gold. So many of these central banks are doing that. But we believe that it's become a crowded trade. We believe charts are indicating the reverse, that gold could be setting a major top here. On the equity front, bearish sentiment across the board. We know that the CNN fear index had been single digits, close to 4 and less. We know that a particular indicator that measures the bearishness, AAIIBEARS, that's been holding near the 60 level, 55 and higher for the last several weeks, last 5 to 6 weeks. There is effectively, major signs of bottoming, with VIX having shot up over 50 and now pulling back and closing below 30. When VIX does that, when VIX shoots up over 50 and closes below 30, often it indicates the start of a fear led bottom and then an upside here. And we've ourselves compared to 1990 as the time frame where we believe this is very comparable. In 1990, US stock market, because the Persian Gulf War had exactly pulled back 21.4%. And from there, we had a roaring 90s, massive upside across most of 90s. We believe we are in a very similar situation. The pullback we got in that short period from the February 19th peak to the April 7th low was exactly 21.4%, just like it was in the 1990. 1990, it happened from July to October. Here, it happened from February to April. And then from here, we believe that we could see signs of market recovery. We could see signs of massive upside in the US stock market. There was almost a 5x climb in 1990, S&P climbing from somewhere near 300 to 1500. So it was a 5x climb in S&P 500. We see here S&P climbing from the 5,000 level, 4835, but about the 5,000 level, triple X to 15,000. That's a bold call that Tom Lee has made in the next 5 to 10 years. And we believe strongly that it's a very good possibility US could be. And a lot of it is technology driven. We can see AI driving this rally. We can see massive, you know, autonomous driving. We can see tremendous amount of electric vehicles taking over. We see robotics, a lot of core call it secular trends, technology driven. Life sciences has huge potential. We see tremendous opportunity in biotechs with the kinds of drug discoveries in unraveling rare diseases, genomics driven, proteomics driven kind of discoveries that are going on. The biggest proof being how we recovered out of the COVID with absolutely stunning discovery on the vaccination for the COVID to help fight it and get the world out of it. So moving into VIX, this is the chart that I want to share where VIX shot up to 60, and from a span of the last 4 to 6 weeks, it kind of came down from 60. 60, actually, not in 4 to 6 weeks. The last, I would say, from April 7th was when it shot up to 60. It came down to below 30 in the span of 2 weeks, right? 7th, 14th, 21st. So we've completed 2 weeks since that shoot up to 60. We are now already below 30 and now closed right below 25. Now, yes, it is testing a key level. In this case, the blue curve is the 50-day moving average. Yes, it is testing that. It is also, as you can see, broke out of 24.8 from the March, end of March level. So it is testing that as now support. So near term, we could see some selling happening, and I'll give other indicators where we are quite overbought in the near term. But from there, we do believe that VIX will continue to decline. We can see that kind of decline back in a similar kind of environment in the August 5th low in the market, which was the Japanese stock market crash. VIX there shot up to 65. Here we touched 60, but they're even higher up to 65. And look how drastically and how rapidly it came back down to 14 in the next couple of weeks since then. Not sure if we'll go back to below 20 right away. We might be, if you look at 1990, we might be for a couple of months where we could be hovering between 20 and maybe 35 or so. And then from there, maybe eventually come down. But, we know there's a lot of volatility in the market. It's very news driven. We know that there's a lot of uncertainty still about tariffs and about just economic policies around the world and so on. So we could expect volatility to remain, but not at the levels of what we saw at 60. We expect it to be kind of hovering in the 20 plus region for the next several weeks. Another indicator of bearishness that Tom Lee talked about is the American Association of Individual Investor bears. We can see that this is a weekly chart. Every candle is a week, that we can see that towards sometime late March, it had shot up. In fact, in the early March timeframe, it shot up to 60, pulled back to 52. It has been maintaining above 50, hasn't gone below 50. Went up again to 61.9 towards that April 7th bottom. And since then, the last 3 weeks, it has come down, but maintaining, it's closed at 55. And this is a weekly indicator. Every week, investors are surveyed, and the percent of bears that are showing up in there maintains at 55 level. So that indicates extreme fear in the market, extreme worry among retail investors, in particular. In American Association of Individual Investors tend to be more of retail investors like you and I, and there seems to be a lot of bearishness in that segment of investors out there. I'm going to talk about treasury yields because they are very big indicators where the market's headed with respect to are we into a loosening cycle. We know that the Fed has stand put and said that we are not doing any measures right now. We're going to watch how the market reacts to There are two conflicting things there. They're worried about stagflation. They think that, yes, because of the high tariffs, perhaps there could be some slowdown in GDP. There could even be perhaps a recession, but they're worried about inflation from the tariffs. So there is that part of stagflation that Fed is extremely worried about, which means high inflation with poor growth. That's where stagnant growth is where the stag part comes, and inflation is from the inflation. They're worried about it, but let's look at the two-year yield chart. And the two-year yield chart, as we can see, did climb during the top time when, from the April 7th, it had shot up to almost 4.04 into April 9th. And that's the day when Trump he reversed his thing on tariffs and he said that let's give a 90-day pause. So that pivot that Trump did, many people call it the Besant put or the Trump put, was watching the yield shoot up. And from there, we can see that the 2-year yield has been drifting lower. This week, the last couple of days, we can see it drifting lower. A key pattern evolving in this chart is from 3.43 to 4.43. That's a 100 basis point kind of a range, kind of a head and shoulder pattern forming. A neckline somewhere around 3.5, 3.5 to 4.09, back to 3.5 to 4.43, back to 3.5, 4.04. If we break below that 3.43, that's 100 basis points subtracted from 3.43 because the top of the head is at 4.43. That takes us to 2.4. So if a 2-year yield goes to 2-year yield, tends to be giving an indication of where we think the Fed funds rate is going to be, because that's a shorter term treasury yield. It's linked to Fed funds rate. So if 2-year yield is going to go towards 2.4, we're expecting the Fed funds rate to come down significantly from the 4.25 that's we are in right now. So like 250 basis points to 4.25, that right there is 175 basis points of cuts. And if we do 25 at a time, you're talking about 7 cuts right there. So we know that right now the market expects 2 or 3 cuts this year, and we got to see what happens from the next Fed meeting, the indications they give. But perhaps we could get 4 or even 5 cuts this year if the economy shows signs of weakening, if the Fed pivots and starts getting concerned and hence starts putting in some stimulus into the economy. So that's something for us to look into. But 2-year yields right now is indicating a decent chance of breaking down, is what we feel, which is bullish for small caps in particular. 10-year yield also had shot up to 4.69, almost 4.7%. That's when President Trump and Scott Bessent pivoted. We know that that was many call it the Bessent put. And from there, the 90-day pause on the tariffs were announced. That's on April 9th. And we can see that it drastically started coming lower. And this week, it kind of ended near the 4.26. Now, this was very interesting. When Trump started talking very harshly about Chair Powell on Monday of this week, on April 21st, that's when in the next day, Treasury yield shot up to 4.4. Then again, Tuesday, he completely changed his tune on Chair Powell. He said he had no intentions of firing him. And again, this is a repeat play of call it the Trump put, because they are more honed in on the 10-year yield more than the stock market, seeing 2 climbs back on April 9th towards the 4.59 or 4.6%, and then towards the 4.4% on Tuesday. They pivoted twice, and on he this time also pivoted on China, saying, the 145% tariff, the max rate that's in force right now, is not going to persist. They're likely coming much lower, he indicated. This is again when China comes out and says that they have not made any deals or they're not doing any negotiations yet. President Trump goes ahead of it and makes these statements, indicates his willingness and his likelihood of him bending a bit on China and giving them some leeways to be able to get a lower tariff rate, and hence being in many ways de-escalating the China crisis or the China trade war that's the markets got very worried about. So that's the 10-year yield. After that, from 4.4 came down back towards the 4.26, 4.27 level. We think that there is a good chance. We see the 50-day moving average in blue and the 200-day moving average in red. This would effectively then have what you call as a death cross, 50 going below the 200. We see that's a good chance, and we see lower trending 10-year yield and 2-year treasury yield over the next several months. So that's again a bullish indicator. Here again, you could say that somewhat of a head and shoulder pattern is forming around 4.1, the 4.5 was the left shoulder. Then from there, 4.1 to 4.8 that we saw in early January was the head, came back to 4.1, kind of the 4.5, 4.6 breaking down. So 4.1 to 4.8, that's 70 basis point, 3.4%. So below the 3.6 is where we think 10-year yield is headed in the next several months. I talked about Barron's showcasing gold, talking about gold is beating everything, how to get a piece of the action, kind of indicating to investors to look into buying gold. This is to us a contrarian sign. When Barron's highlights gold in their front page, when it gets that much of attention and everyone's talking about gold, it's become too crowded a trade, too late to go into the trade. And we'll tell you why. Look at the parabolic climb in the daily chart of gold. From a level near 2,500 towards like right after the election, towards mid-November, see where it climbed from 2,500 to 3,500, 1,000 point climb in gold, which is a straight 40%. A 40% climb in a span of what, November to April, that you're talking about is roughly 5 months. That to us is extremely unrealistic. Gold climbing that far up in that parabolic fashion, and every parabolas have bad endings. That's the way we look at it. And look at when gold climbed a higher high from 3,100 peak to the 3,500 peak. Look at RSI. That's at a lower high. That's how tops form. That's how negative divergence happens. We believe gold is eventually breaking 3,000 and going back to 2,500. We would caution as a result. We can see that the MACD is now turned lower since that peak at 3,500. It's been coming lower. It might hover around here, holding the support near 3,250, but we do believe it's breaking down, going then testing the rising 50-day around 3,000. And from 3,000, we expect it to test there, maybe consolidate a little bit, and then eventually down towards the 200-day 2,700. But we believe 2,500 is very much in the cards in the gold in the next several months. Now, this is a longer term chart of gold. Every candle is a year. And looking back from early 1970, we can see that gold typically has a run of 11 years from a secular bull market trend. From 70 to 80, over the 11-year period, gold had a parabolic climb. And then from there, it consolidated for many years till the next big bullish climb from 2001 to 2011 peak. So that was the 11-year climb. And recently from 2015, which was around the 1,045, it has climbed to 3,500 in a similar 11 years. So 11-year cycles is what gold follows. This is a long-term secular trend. We've hit that 11-year cycle. So we believe 2025 is the year. And notice that every peak, you form a long tail. Now, not in this tail, but a long wick. The tail is usually the bottom of the candle and the head is on the top, but the wick, the body of the candle represents the opening and closing for that particular year, but within the year it had shot up to 1920, close much lower. When you leave a long wick like that, that's a reversal wick, and you typically see those wicks when you start getting a pullback. You see this long wick and then pullback after that. We're setting up a long wick. 3,500, we're already way below at 3,300. We expect this to go even lower and maybe close towards the high 2000s, maybe have a short body, a long wick, indicating that just like we saw in the 2011 peak and we saw in the 1980 peak, a peak setting up in 2025. So 11-year bull cycle, it repeats. This is the third such cycle. We believe be extremely cautious on gold and heed. If you want to follow Barron's, be very careful. I would consider it as a contrarian sign and stay away from gold. Talk about Bitcoin, rather, is where we feel the opportunity is. We believe that this is now the time to do a pair trade, long Bitcoin, short gold. That's what's going to pay off. We believe that Bitcoin relative to gold is actually going to do much better. We know that Bitcoin had a double top pattern in the 109K, broke down from it, tested a low at 74.4K on April 7th. Since then, it's leading. It has broken up before S&P broke out in the last like couple of weeks. It broke out above its 88, like 86K was where it was kind of consolidating. It broke up above 86K, took out the resistance at 88 and jumped straight to the 95, 96 level, which is where we see is previous resistance. So from here, we could get some consolidation. This day, like today on Sunday, we can see gold pulling back a little bit. But from this consolidation, we expect a continued climb to retest that peak at 109. We see that strength. We can see that RSI is broken out from that consolidation. It was hovering around 50, climbed up to higher towards the 70s. We can see that MACD is broken up above the center zero line and now in the positive territory, and we expect it to continue climbing. All of that is very bullish. And remember, yes, bears would say, oh, this is a death cross of the 50-day below the 200-day. Ignore such death crosses when the 200-day, which is the much longer term moving average, climbing. The red 200-day moving average is climbing. That's a bullish trend. So when you get such death crosses, the bullish trend of 200-day climbing, that turns out to be invalidated, and we expect the 50-day to climb back up above the 200 and from a golden cross. So this was just a false signal. The 50-day only temporarily dipped below it. We expect it to take and climb back above the 200 and from there continue its climb. That's what we believe. And we believe that if you look at the ratio of Bitcoin to gold, we believe this is a beautiful time. You can see that there's a rising channel joining the peaks and the bottoms. It did break below it temporarily for a couple of weeks, and then from there it's taken out. This is ratio of Bitcoin to gold prices. Where do we think that's headed? We think that's headed towards a level near 60. 60 ratio of Bitcoin to gold would mean gold around 2,500 and Bitcoin at 150,000. That's where the number 60 comes from. We believe that this is going to start climbing higher. It's already taken out the bottom end of the channel and kind of coasting higher. We believe relative ratio of Bitcoin outperforming gold is the trend now for the next several weeks, next few months. We can see that MACD is also oversold, is beginning to turn higher. If you want to diversify outside regular stocks and treasuries, consider buying Bitcoin versus gold. We believe Bitcoin has a lot more upside. So that's something to think and consider. I'm going to now talk about S&P 500 and look at some of the advanced decline lines. And we can see this this is a cumulative chart of the advanced decline line. We can see that during the bear market in 2022, that cumulative chart declined from high towards a lower low. That higher, like lower high, lower low, was an indication of the bear market. Since then, guess what we are doing? We are actually climbing higher lows, higher highs. So as much as the bears are saying the world's coming to an end, S&P 500 has topped out at a multi-year trend. That's not what the cumulative chart of the New York Stock Exchange advanced decline trend is showing us. We see a nice test of the rising 50-day moving average, and then from there a nice reversal. We can see that MACD is kind of over the last 4 months, kind of bottomed out from a histogram perspective below the zero, and we expect it to begin to climb. And we believe that breadth is only going to improve. So when people are talking about the Zweig breadth oscillator and how breadth is improving, we expect continued breadth improvement in the market. And that indicates small caps are actually going to be doing quite well if market breadth, because small caps are more number of stocks. These are Russell 2000, about 2,000 stocks right there, versus S&P 500 only has 500 stocks. So we can expect, as the market breadth improves, the internals improve, outperformance of the small caps and more participation across the market, not just in the Magnificent Seven large cap stocks. This is the summation index of the same New York Stock Exchange. Here we looked at the advanced decline line, the advancers minus the decliners. Here looking at the summation index, calculated similarly, but in a cumulative fashion and adding it up over time. And that when it shows 1100, that's the peak that it typically touches, and minus 1100 is with the bear market kind of bottom that the summation index sees. We see that recently it has put a higher low. Back in October 2022, it touched minus 1100. Then in October 2023, it touched minus 834. In this bottom that we had in the trade war concerns, it was minus 590. And then it has begun to climb, a solid climb this week. Again, an indication of the Zweig breadth thrust. We can see how big a climb we got, a span of 48% climb in the summation index from near minus 500 towards the minus 279. Now that indicates, if you look at previous climbs, when the summation index climbs, it typically monotonically keeps climbing for consecutive weeks at a time, 8 to 10 weeks easily. So here we can see back in 23, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, it started climbing. Here in the span of 24, from here 1, 2, 3, 4, 5, 2 weeks pullback, 7, 8, 9, 10, 11, 12, 13. For a span of 13 weeks, it had a climb of higher highs, higher lows. So we expect that climb is begun. at least 2 to 3 months of climb to continue on this for the next 8 to 10 weeks. And that means the market has got decent upside coming ahead of it. Now, if you look at the McClellan oscillator, which is more short term, this is a daily chart, that is indicating, however, a little bit of an overbought market. From a span of minus 90, it's just towards the plus 90, towards the plus 87, which is even higher than what we saw back in the mid-July timeframe last year and what we saw recently in mid-January. So that indicates, and it is pulled back on Friday a little bit even though the market closed higher, that indicates that near term we could be setting up for a pullback. The MACD histogram is also very overbought. We can see in the past when it becomes that overbought, it then for several days starts, this is daily. So this is a daily oscillator showing daily market breadth, could start coming down. This is what happened back there in July as well. When MACD becomes that overbought, it starts coming down. So we could see a few days to a week or two of pullback, but then from there resumption of the climb. Now look at S&P 500's daily chart. Bears were effectively waiting for this pivoted high that we got on April 9th at 54.81 to fail. And we saw that the first time it came, it failed. It didn't go to 54.81. It went to 54.59 and came down. And bears were looking for this to come down and break 48.35 and go a lot lower. There are many bears are looking for a 4,400 or even 4,000 on the S&P 500. We don't agree that's going to happen. We agree with Tom Lee that if any, we are seeing a beautiful cup and handle pattern, 48.35 towards the 54.81. That's roughly, you're talking about 650 points or so at the 650 to 54.81. That takes us back above 6,100. That's where we think S&P is headed. Yes, we broke above it. We closed above. And so key levels to watch is on March 13th low, it was 55.04 from where we had come towards 5,800, couldn't succeed, tested the 200-day, and then from there broke down. So now the next level of having broken this resistance at 5,500 and we closed above it at 55.25, we could get a near-term pullback, but we expect this to go back towards the 5,700. And we can see that the 200-day moving average is at 57.45. It's about 57.46, and we know that this is 57.86. So around that 57.50 level is where we think S&P is headed in the next few weeks. That said, because the oscillator near term is a bit overbought right here, extremely extended, we could see some bit of a pullback. But near term, we expect this gap to close out. That's near 55.70 or so. So we expect if we kind of put the level right there, we can see that the low is right at 55.71. So we expect that gap to maybe close out in the next few days. And from there, we expect that perhaps we could start seeing a bit of a pullback, and then from there a resume climb. We could get the pullback to close this gap out near 5,300. So yeah, from the like level of maybe the 50-day moving average, which is around 56.36. So we could perhaps get there near the 5,600, pull back to close this gap at 53, and then from there a resumption of the upward trend is where we're expecting. I'm going to now talk about Nasdaq. The Nasdaq's oscillator is called NAMO. That's also extremely overbought, touching the July level of 85, 84.82, and we see it slightly pull back on Friday. We expect this is also very overbought MACD histogram like it was back in July. So we expect some deterioration in market breadth, indicating some form of a pullback in the Nasdaq coming ahead. And this in particular is the advanced decline line, looking at it from an hourly chart. And when you look at an hourly chart, you notice that it oscillates the histogram from the below the zero line to above the zero line for every couple of days. For a few days, couple of days, it stays below. Then for a couple of days, it stays up. Couple of days, it stays below. 2 or 3 days, then it goes up. So that's how it oscillates back and forth. Guess where we are now? For the last 2 days, we have been oscillating below the zero. Expect this to, and by the end of the day on Friday, we notice that it has started climbing. We expect this to have upward trending move into Monday, Tuesday of next week, and perhaps this will start showing us some bit of upside in the market. And then maybe with Wednesday's news, we have Meta coming out and we have Microsoft. We'll see how and then 2 other majors, Amazon and Apple. We might get some bit of a pullback. Maybe those four Magnificent Seven earnings may not be as wowing, and we may get a pullback as on those because we know that they've had strong recoveries already. And if that does happen, then that could be a buying opportunity because we believe the market is going back higher. This is QQQ chart. It also had a pivot high on that April 9th at, we can see, at 467. Guess what? It broke above it. It broke above it, closed at 472. We believe it's headed to test its 50-day moving average, shown in blue here around 479. That's where we think it's headed. You can also see the 479 from that early part of April. That will now turn out to be resistance. We believe it will fail at the 50-day. We are already seeing the Nasdaq oscillator extremely overbought, so we believe that it will fail there. And from there, we get a pullback towards maybe closing out this gap right below 460s. Let's look at where the gap is. It's just over around it, and we can see that the gap is around 447. So believe a pullback from 479 to 447 would close out that gap, and from there we expect market to continue much higher, eventually scaling back above the 600 level and the 500 level and taking it high. Looking at the two core sectors that did extremely well last week, one was the software industry, over 9%, and semiconductor, over 10%. Consecutive 4 days of climb, 1, 2, 3, 4. This gap higher happened because of President Trump being very, very bullish on the tariffs, saying that the rates are going to be much lower with China. That helped the software and the semiconductor sector to climb higher. ServiceNow was in the earnings. They did extremely well. That powered the software sector higher. And we know that in this particular gap higher, it has since then been climbing. And we expect this to it actually was bullish in the way that it closed above the 200-day moving average at 94. It didn't hold that back as resistance. It closed above it. Now the measured target on this cup and handle is from 76 to 89. That's 23 points. At 23 to 89, 112, which is above the previous peak that we saw in December at 110, 111. So we expect higher highs coming on the software industry eventually. Though near term, we expect maybe the 96 level to be resistance. From there, a pullback to close this gap near 86. We can see a like this pullback here. That could be a right shoulder pullback. So a neckline at 96, a right shoulder kind of a pullback towards 86, 87, and then a break higher. And if we do that, then 76 to 96 is 20 points. At 20 to 96, that's 116, even better. We can get towards 115, 116 in the software sector. A similar kind of a cup and handle breakout on the semiconductors. We know that particular day when the 90-day pause on tariffs were announced, it had hit a high near 212. So 170 to 212 is 42 points. At 42 to 212, that's 256. That's where we think it's headed, and we think that this is a beautiful cup and handle forming on the semiconductor headwill. Finally, on the small caps, a beautiful cup and handle here. It's of course much muted in its climb. It's really waiting for 2-year yield to break down. If 2-year yield breaks below the 2.43 level I'm talking, this is going to take off to the races. Small caps earnings comes more in May, so it's also going to see the regional banks that drive the small caps higher, the biotechs and so on. We'll get to see their earnings come out in the next couple of weeks, more towards from May and onwards, and we'll see how it reacts. But we believe this is a beautiful cup and handle, 171 to 192. That's a 21. At to 192, that's 213. That's right where we see in the past was actively support, which now becomes resistance. So we think IWM is headed to a 213. We feel that it's nicely bottomed out, and this is the key message. AD, which is the accumulation distribution, climbing. In this whole sell-off from the April 7th, look at how smart money is accumulating AD, climbing to a point where it's now even a higher high than it was in the November timeframe. That indicates money coming into small caps. That indicates accumulation. That indicates small caps have got a very good move ahead. Semiconductors also, we can see money moving in, accumulation with all the fear of NVIDIA and the semiconductors getting hit by China. Look at the movement of the money. Accumulation is bringing it to climbing highs. Hasn't taken out its high from February, but it is getting there. It's AD climbing. And the same thing with software. Look at the AD. AD is at much higher than ever in the last several months. It's at its highest high. That indicates software is hugely under accumulation. Dan Ives was out there talking about software as the best place to be in this environment, and he talked about a Category 5 storm hitting the markets with the tariffs, and software was the safest place to be in. And he could be right. He, of course, talked about Palantir. He talked about cybersecurity stocks. Palantir earnings doesn't come out later in May, has been outperforming, going much higher. And those stocks, we'll talk about it in one of the blogs next week about Palantir. We believe Palantir is headed to 130. That's where we believe software sector, Palantir is like the number 2. We did have a blog actually. So sum it up, we did talk about in this April 22nd weekend chart patterns about IGV, which is that software sector ETF, and some of the key stocks. If you go click on it, you can start seeing that we talked about Microsoft. We see maybe Microsoft will eventually resume some of its climb. We talked about Salesforce. We talked about Palantir. And this is the target right there, above 130 is where we believe Palantir is headed. So with that, thanks for listening. We feel that to sum it up, VIX shot up to 60, pulling back, testing its 50, might be range bound between 20 to 35 in the next several months. But we do believe that VIX coming down that fast indicates a bullish reversal in the market, indicates the market bottom is in place. We believe that the AAI bears have been high for an extended period, indicating too much of bearishness out there. We believe that the 2-year yield is going to break below 3.4 and go towards the 2.4, which will be extremely bullish for small caps. We believe the 10-year is also setting up for a death cross of the 50 going below the 200. That means it could eventually break the 4.1 neckline as the head and shoulder pattern. 4.1 to 4.8 is 70 basis point. Subtract that from 4.1, that takes us to 3.4. So that's where we believe the 10-year yield is headed. We know Scott Bessent is maniacally focused on 10-year yield. He would love to. And if you imagine 10-year yield going to 3.4, we're going to start seeing 30-year bonds, which is what the mortgage rates are on. Many of them take 30-year mortgage loans. That's going to come back towards the 6% if the 10-year goes towards 3.5. At least a 6.5% is where it'll go. So that's where we think that potentially 10-year yield is headed. Barron's being very bullish on gold to us is a contrarian sign. Be very careful on gold. We believe this parabolic climb is not going to end well. We believe it comes back, deflates from the parabola down towards from where it started near 2,500. That's where we see gold headed. And if any, we believe this is a very long-term secular trend. The 11 years peaking, just like we have in the past, 1970 to 1980, and then 2001 to 2011. We believe the same peak from 2015 to 25, that 11-year peak is happening this year. Moving forward for the next several years, we believe gold is going to be nowhere close to the 3,500. So it's a multi-year peak in gold. Be cautious on gold. And we believe Bitcoin is going to be a beneficiary. We believe the continued climb in Bitcoin to retest its 109,000 and then from there break higher towards the 150,000. The ratio chart shows relative strength of Bitcoin over gold, indicating a good, nice pair trade. Buy Bitcoin, sell gold. This ratio could climb back towards 60, which means gold at 2,500 and taking a multiplier of 60, Bitcoin at 150,000. And the key charts of S&P 500, we believe right now headed towards testing its 50-day and then maybe pulling back to close this gap near 5,300 and from there climbing higher highs. QQQ, we believe, is also something similar. It's going to break higher and continue climbing. And then with the software and the semiconductors, more upside there, some resistance, some software at 96, and then a pullback towards 87 to close out this gap. We're all about a pullback to gap close is what we think is going to happen in the next couple of weeks from an overbought. And then that would be an amazing buying opportunity for us to play significant more upside. With that, good luck investing. We'll talk to you guys next week. Thank you.